Hey guys, Steve here from theturtlefollower.com with the trade school video for this week. Today we're going to take a quick look at some introduction to placing stops. I know we've talked about it briefly in the past, but again, this is something that I think is very important to managing a position, and it's not necessarily the entry that is the most important of the processes that you take to manage a trade, but it's more about managing your risk at the end and during the trade and making sure you fulfill your trading plan by exiting when you're supposed to. And this video is kind of going to go into real quick where to set a stop so that you're not giving it too much room, but you're also in the same respect not giving it too little room to let the trend work. So this is the way I do it. We're also going to be rolling out in the beginning of next year. We're going to also be rolling out some e-courses, so I wanted to put this out, but then I'll probably expand on it a little bit in the e-courses as well for all the beginners out there. So this is a chart of the triple Qs, which is the ETF for the NASDAQ QQQ. And I just want to basically, we talked about support resistance, so that's really what my stops are based off of. So if you were to say enter this trade on a breakout over, let's say, just for argument's sake, right here, over 88.21, you would be first setting your stop down here at 84. All right, so what is a stop? A stop level is a price that you feel you are no longer right in the trade. Meaning, if I say, okay, I think the stock is going higher, well, at what point do I think that I am wrong and the stock is now actually going lower? So whenever you go ahead and are going to enter a position, you always want to set a stop. I personally, and what I preach in the model portfolio and the strategy sessions, is I do not physically set an order. Instead, what I do is I set an alert for a close below a certain level. Everything is based on closing prices. What does that do for me? That keeps me out of all the intraday noise, and it allows me to focus mainly on closing prices. So with that said, what does that mean in terms of looking at it on a chart? Well, let's say I had my stop right here at 86.20. Okay, I use this level for whatever reason. I would have technically been stopped out on this bar, this bar, this bar, and this bar. Okay, 4 possible times that I could have been stopped out on this trade. By using closing prices, I am still in the trade. Okay, so how many of you out there have had stocks go down during the day, you sell them on a stop, and only to have them go right back in your face, close higher on the day? I mean, it's got to be almost everybody. I can't believe it hasn't happened to you, and if it hasn't happened to you, great. It means one of two things. Either you're not using stops or you're not being honest. So I think at this point, I personally use stops based on closing prices. It helps me so much in my trading. It's one of the best things I could have ever done with my trading, and it kind of allows me to let the trade play out and not be so worried about the intraday movement. Anyway, so say we were to take our stop. Let's remove this. We were entered a trade here at 88.20. We set our stop alert down here at 84. So a close below 84, exits out of the trade, size the position accordingly, blah, 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 blah. All right, so we're in the trade. Now trade's moving up, trade's moving up. Now the key to risk management is, where do you move your stop? Well, looking at it from the way we just did, to be honest, 86.22 would be my next stop level. So what do? I move my alert. That becomes a red line, and my previous trailing stops become gray lines. So at least I can watch the progression of the trade. Now, why was it set there? Because as the stock moves higher, you can identify a consolidation between two levels. That's what I use to judge my stops. As the stock continues higher, you always want to trail your stops to previous lows. Okay, so now the key here is timing it so that you're trailing your stops only when, and this is my personal preference, again, other people may have different thoughts. This would be the next stop level here. You only trail stops when a close below that level also breaks your trend line and the 50-day moving average. So when you got this breakout back here, let's look at it from that case. Okay, there's your breakout. I would never set my stop here. This is the point where I would probably still have my stop all the way down here at 86.20. And the reason I would not set my stop here is because it closed below 90.69 does not close below the primary trend line or the 50-day moving average. Okay, it would only be until probably this breakout in here, right when the stock is moving to 93, that now I would move my stop to 90.69. And again, as it goes sideways more, so this would be another stop level. And again, this level would not be put into place until probably right about here. Okay, so on the 13th. And the reason for that is the stock tested, moved higher. I can't set my stop here yet because a break of this level still does not break the trend line and the 50-day moving average. Now when it came back and tested the 50-day and the trend line and eventually turned around and broke out, that allows me to now confidently say 94.17 is my new stop level, because at this point, if the stock reversed, broke 94.17, it would also be breaking trend line and 50-day moving average. So what does that look like on the longer term? Basically, my trade entering here on this breakout on May 21st has only trailed stops 3 times. Here would be a stop. Okay, so you had your initial stop down there at 84. There's your next trailing stop at 86. Here's your next trailing stop. And to be honest, it would actually have one more. There's your next trailing stop at 92. And then your next trailing stop, which is actually your current trailing stop, if you were still in this trade, is right here at 94. Now, some people do like to use highs as stops. I personally prefer always using the pullbacks, okay? Because what I've found in the past is when you go ahead and set a stop here at a high, even though it exceeds the 50 and the trend line, a lot of times what happens is it comes back and slightly breaks that stop level and then reverts back to the highs. So I personally like to use lows, and if you're looking at this from a support and consolidation analysis like we had last week in our trade school video, there's a small consolidation, there's another one, and here's another one. So you could see all of our stop levels are anchored by support of consolidation areas. All right, so this would be allowing you to take your trade that you entered at 88, trailed your stop from 84 to 86 to 90 to 92 and to currently 94. That's how you manage risk, and that's how you let your winners run. Still in the trade, you're not stopped out by these tails of these candles back here because you're using closing prices only, and you're using alerts to trigger you to action. Those alerts were never triggered because you never had a close below those prices. All right, so I hope that helps. Again, we're going to have more information on that in the e-courses that are coming up in the beginning of the year, and we'll see you tonight for the strategy session. Hope you guys enjoyed that one. Take care. Have a great rest of the day.